Welcome back to Be Rich. This year has been a terrible year for the stock markets, not only in US but across the world. But US stock markets and bond markets are the ones which have been the talking point for investors across markets today. The other markets have also deeply corrected, but the world only sees the US market because most of the world's major companies are listed in the US. Their broad measures is the S&P 500, which has corrected nearly 19% and at one time was down more than 20% in the market. The tech heavy Nasdaq has corrected by 33% and is definitely in a bear market. Rising interest rates are to be blamed for this. For nearly 20 years, except for a short period, interest rate we have had a for the last 20 years, except for a short period, we have had very low interest rates for markets, and this has meant that in a rare combination, both equities and bond markets have been in a constant rally. After the crisis, the century started with the crisis in the IT stocks, and interest rates were cut by Alan Greenspan, and we called it the Greenspan put. Before interest rates could slightly raise to 3 or 4% and reach reasonable levels, there was a global financial crisis triggered by the saving the housing loan market. This meant that money had to be printed and what was called as quantitative easing, and interest rates came to near zero. The COVID impact meant that the loose monetary policy continued and more quantitative easing was of the order. The world believed that they had solved the inflation problem because China and Far East Asia was acting as the factory to the world. This meant that inflation never went up and interest rates could be kept very low. First, the pandemic created problems because money was directly put into the hands of the people. And as the pandemic lifted, the people went out and spent it, and inflation began to rise. Jerome Powell first dismissed it as a transient problem because of supply chain shocks. But as time went by, the supply shocks got entrenched and became in wage inflation. This meant that Jerome Powell had to quickly backpedal and say that inflation is not transitory but is definitely entrenched. But he woke up and started to ratchet up rates, followed with a point 0.5, and inflation did not show any sign of ebbing. Therefore, he had to follow it up with 4.75 interest rates and pushed up rates as high as 3.5, and then has followed it up with another half a percent interest rate. Even these steep price rises have not crushed inflation. Core inflation still remains a cause of concern, though easing fuel and food prices have meant that headline inflation has come down in America. The Fed has clearly indicated that it will increase interest rates at least twice before cooling off. The Fed terminal rate, according to the Fed, is around 5.5 to 5.75. We are nearly 125 basis points away from this. This has meant that global stock markets have tanked, yields have gone up. The treasury yield for 10 years, which was 1.5%, has shot up to 3.9%. This meant all rates have gone up, and a lot of there's a liquidity crisis in the bond market because the treasury represents the risk free rate, and if this is at 3.5, then all rates have to go up. Mortgage rates in US are now at nearly 6%, a level unheard of for more than 15 years. Housing prices have collapsed, and prices of used cars, which initially started the surge in inflation, have corrected. However, there are lesser people for jobs, and therefore there is pressure on wages. And this wage inflation, if entrenched, can fuel further inflationary pressures. So the Fed has to crush inflation. One can expect a further 1 to 1.25% increase in interest rates and a prolonged pause before the Fed cuts. It is most likely there will be a recession in America next year. All this has meant a huge sell off in both the bond and in the stock market. Tesla, which was at $450, has corrected to $112, a drop of nearly 72%. This was further accentuated by Elon Musk's eccentric behavior in attempting to take over Twitter. He has to sell a big portion of his Tesla stocks, which he vowed not to do, and pledge a larger stake to secure funding. This has put further pressure on Tesla stocks. Apple and Microsoft are down 30%. Google is down 40%, and Meta down 64% because its revenue model is gone off rails. These are very surprising because nobody expected the tech giants would suffer. For years, their revenue has continuously increased and not come down. Even during the COVID, the revenues went up substantially and the prices of these tech stocks were in a tear. Post COVID, when normal behavior started to come back, the earnings of these companies slowed down and all the staff they had in, added during the pandemic have become redundant. America is exotic trap where high-end jobs are being lost with all the tech giants throwing out people and even JP Morgan and Goldman Sachs sacking people. At the same time, at the lower end, in restaurants and places like Amazon, there are no people to do lower end service jobs and people are demanding more and more money to do mundane jobs. Also, falling birth rate and tight immigration laws have made the labor markets in US. I do not think we are going to lick the inflation problem this year, but at some time the Fed will blink. Till that time, the US market is going to be in throes of a correction. After many years, we are going to have an year where the stock markets and bond markets have been savaged and rates look reasonable. It is time to shop in the US, perhaps in the first quarter of the coming year. In this channel, we will be talking more about such stocks. Thank you for watching Be Rich. If you like the content, hit the like button of this video and subscribe to my channel. Turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for your support for Be Rich. Kim, I want to ask you a favor. I want you to share this video with your friends and relatives and persuade them to watch this video. Once again, I thank you for your support for this channel. I want to thank all of you for supporting our event in Oman with great enthusiasm. A lot of people turned up in Oman and a place where I don't have much influence. I wish to thank all of you for your support. The next event is going to be in Qatar, Doha. The event is scheduled for the last week of January. Those who would like to meet me in person in Qatar, Doha, or come to our event in Doha can send their request to the mail ID given below or contact the WhatsApp number flashing on the screen. My team will respond to you. See you in Qatar in the last week of Jan. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.